Well, it certainly is good to be back here with a new video, but that comes after 3 weeks of just taking some downtime and spending time mostly with friends and family, meeting our new, now 3-week-old granddaughter. That was a thrill. And of course, we spent a ton of time with her big 3-year-old sister as well. So just a lot of that. That was really good. I did notice, though, that while I was on vacation, the economy did not miss a beat. And while I was taking that time off, a lot of economic data just kept rolling in. And it has been a very busy 3 weeks, actually, of reports, both from here in Canada and the US, covering inflation, jobs, trade, and manufacturing. There is a lot to catch up on. Some of the numbers that we saw weren't what we expected. So I'm going to break that down in this video here, piece by piece, and highlight where it matters the most. So I want to start right here in Canada with inflation. That rose to 1.9% in June. That was up from 1.7% in May. That is still under the Bank of Canada's 2% target, but it is creeping closer and closer. So what is behind this increase? Fuel prices, they're still falling, not as sharply though. Deflation slowed to 13.4%. That's down from 15.5% in May. That did help push overall transportation costs less negative to 0.6%. Now, durable goods, we see passenger vehicle prices. They were up 5.2%. Furniture prices spiked 3.3%, and that's a big jump from near zero last month. Food inflation, this slowed again, 2.9%. Shelter inflation was down slightly to 2.9%. That's down from 3.0%. Now, core inflation, and this is really important because this is really what the Bank of Canada pays most attention to. We want to look at the trimmed mean CPI. So this is closely watched by the bank. That held steady at 3%. So we saw tariff and supply pressures. They are likely behind some of the increases that we saw, just like the Bank of Canada had anticipated. But while we do see the headline inflation that's remaining tame, core inflation, that's still pretty stubborn, and that complicates any hopes that we may have of a near-term rate cut. Now, next I want to look at Canada's trade deficit for May of 2025, and this narrowed to $5.9 billion. That's from April's $7.6 billion, and that's a positive step. Imports, they dropped by 1.6%. That were driven by big declines in metals, down 16.8%, and vehicles down 5.3%. Exports rose 1.1%, boosted mostly by non-U.S. trade. So shipments to countries other than the U.S., they spiked 5.7%. Now, notably here, metal exports were up 15.1%. That's quite a jump. And consumer goods rose by 2.6%. Now, one important thing to note here is that some of these shifts may be tied to tariffs and administration delays from the new CARM customs process. That's the CBSA Assessment and Revenue Management System, which took effect in October of last year. So overall, the numbers here are bad, but less bad. So I guess that's good, but we still need to be cautious in this regard here. It could sort of be some policy quirks, but not necessarily economic strength that might be doing the heavy lifting here. If we do see trade tensions continue to ease, then we'll see if this trend holds or if this was just a one-off. Now, third on the list, Canada's labor market for June. That brought a bit of a surprise with a drop in our unemployment rate from 7% to 6.9%. And that's the first improvement in 6 months. And it did also beat market expectations. Some details here, 83,100 jobs added. That's the largest increase since December. And those gains came mostly from part-time jobs, especially in wholesale and retail trade. Long-term unemployment still looks concerning. Over 21.8% of unemployed have been jobless for more than 6 months now. Participation rate did tick up to 65.4%. So this was a pretty strong print if you look at it just on the surface, but I do want to sort of keep things real, be honest here. Part-time work, in this case, can mask underemployment. But that all said, it is a nice welcome break, I guess you would say, from the months of softening data that we did see, and it should keep the Bank of Canada sort of in that wait and see mode. Now, I do want to move on to the latest U.S. inflation numbers that ticked out while I was gone as well. But first, I do want to take a moment to tell you about the Blossom Investor Conference. And this is Canada's largest event for self-directed investors, and it brings together the country's most engaged investing community for a day of education, inspiration, and connection. And this is hosted by Blossom, the investing social network, where over 300,000 retail investors are sharing their portfolios, their trades, their investing ideas. And the Blossom Investor Conference, this is a live extension of the conversations, the meaningful conversations that are happening every day in app. This year, going bigger than ever. On September the 21st, we're taking over the iconic Rogers Centre, home to the Toronto Blue Jays, to host thousands of investors under one roof in what will surely be an unforgettable stadium experience right in the heart of downtown Toronto. Now this year, you can expect actionable insights from creators, from finance pros, real talk about building wealth, and a space where learning about money actually feels fun. Now, other tour dates this year also, we have Calgary, August the 27th, Vancouver, August 29th, Montreal, September 24th, Times Square, New York, October 3rd, right outside the NASDAQ building. Then we also have Los Angeles, Vegas, and other dates yet to be confirmed as far as the time is concerned. So whether you're an investing beginner, whether you are a seasoned DIY investor, or somewhere in between, this is where Canada's investing future shows up and shows out. We can't wait to see you there. Now, turning to the US, we saw headline inflation also moving up in the States as well, hitting 2.7% in June, up from 2.4% in May. That's now the highest number since February. So what pushed things up this time around? Well, food prices, they rose to 3.0% year over year. Transportation services jumped to 3.4%. We saw used cars and trucks bouncing back, rising 2.8%. Gasoline, energy prices, they fell less sharply. Gas was down 8.3% compared to 12% the month before. Core inflation also crept up. And the annual core CPI rose to 2.9%. That came in just under the forecasts. Monthly core CPI increased to 0.2%, and that was softer than expected. So when we look at the data out here, the energy trends eased the drag for sure, but we saw sticky service inflation that kept prices elevated. And the Fed here will probably be happy about this modest core reading. Not a green light quite yet, though, for rate cuts. Now, 5 on the list today, the U.S. durable goods orders. This came in for May 2025, and factory activity came roaring back. No other way to put it. U.S. durable goods orders jumped 16.4% in May, the strongest monthly increase since 2014. So why so big? Well, transportation orders, especially non-defense aircraft, they were up 230%. And even if you exclude transportation, orders were up 0.5%. So in a nutshell, this is a huge number, but it is no doubt skewed by those major aircraft deals. When you look at it, though, even from a broader data perspective, it does show resilience in business investment. Now, U.S. manufacturing ISM PMI. So manufacturing is still contracting, but less so. The ISM PMI rose to 49 in June, up from 48.5%. Now the breakdown here, production did rebound, now above 50. New orders and unemployment were still falling though. Inflation ticked slightly higher. Tariff-related price pressures, obviously a factor there. The main takeaway in this PMI number is that manufacturing is still wobbling, but not collapsing. So you look at the mix here, it suggests that while production is improving, demand and hiring aren't quite there yet. Now, number 7 on today's list, U.S. job openings for May. The U.S. job market here, it does remain tight. We saw openings jump by 374,000 to 7.77 million. That's the highest since last November. Though the demand for workers, it is still hot, but we're not seeing the same follow through in hiring. And that's the key on these reports right here. It is a tight, but a very cautious labor market. Now, if we look at U.S. non-farm payrolls, number 8 on the list here. The jobs report showed 147,000 gain that beat expectations, and it held near the 12-month average. Where are the gains? Well, government jobs led the way here, 73,000, mostly in education. Healthcare added 39,000, and social assistance grew by 19,000. Now, federal government employment, that shrank by 7,000. So to put this in summary here, we're seeing a steady, broad-based report. There are signs of continued strength, but also no acceleration. So you look again, flipping it back to the Fed watchers, they're likely going to interpret this as further reason just to hold interest rates steady. Now, number 9 on the list today, U.S. unemployment rate for June. That actually dipped down to 4.1% from 4.2%. That was unexpected given that there were forecasts for a rise. Now, some of the details here. The unemployed persons, that fell by 222,000. That pushed the participation rate down to 62.3%. The broader U6 rate, that fell slightly to 7.7%. So what does this all tell us? Well, when you see that drop in unemployment, that usually looks pretty good. But with that declining labor force, we need to ask why fewer people are actually looking for work. Those participation trends, that could be a red flag for the longer term. So if I look at some themes and some market implications here, number one, inflation. Both Canada and the US, we saw headline inflation go up in June, but core inflation, that stayed steady or actually softened slightly. In Canada here, inflation is now close to the target. In the US, still pretty sticky. Labor markets, Canada, we did surprise with the jump in jobs, albeit part-time. The US remains consistent, solid job creation, low unemployment, but weaker participation. Trade and manufacturing, we saw that narrower trade gap here in Canada. That's welcome, but potentially artificial. The US durable goods strength might not last. Those aircraft orders, like I said, skewed things quite a bit. Still, there is underlying investment that is holding up. Now, as far as the policy outlooks are concerned, here in Canada, the chances of a July rate cut look slimmer and slimmer after those strong jobs and stable core CPI. For the Fed, inflation is sticky, jobs are solid, and rate cuts still seem like they may be a way off yet. So what did we learn by all this? Inflation ticking up, not a runaway though. Job market's solid, but there are hints of underlying stress in participation and in long-term unemployment. Central banks, wait and see mode. There's no panic, but there's no rush to cut either. What is your take on all this? Do you think that the central banks are waiting too long to cut? Is the job market, in this case, masking deeper weaknesses? Let me know what you think in the comments below. I would love to hear what you're seeing in the area that you live. Be sure to like the video, subscribe, hit that notification bell so you're not going to miss the next report. As always, I say thank you for watching this video, and we'll see you again in the next video.